How many times did this happen to you? Where the market looks very bullish so you buy long, but then the market instantly reversed back down into the stop loss. Well, in this video, I have a solution for this common, known, and frustrating experience, so let's jump right into the video. You're getting trapped. That's the best explanation to this problem. And it's all about the structure of candlesticks, so let's see what's the problem and how to avoid it. We first need to understand the concept of candlestick closure. So what is a closure? Well, if we're looking at any price chart on any time frame, let's say this is the 4-hour time frame. That simply means that each candle represents the price movement that happened inside a 4-hour time span, so that means that every 4 hours a new candle opens, while a previous 4-hour candle closes. So for example, this would be our closure. This would take place at the start of a new 4-hour candle. This would be the open price of the new candle that just opened on the end of the last 4-hour candle. And once again, we get a closure and open. And this continues, and so on. Now, if we take a look at this price action here, the market is following an uptrend, forming higher highs and forming higher lows. Now, the market is pushing up to form this potential higher high. If the market is able to close above this high, that would increase the chances of a continuation on uptrending movements. Meaning, we could continue to hold a buyer's view on this market since we know it's going up because it's continuing to make new higher highs. But if the market does not close above the swing highs, and instead, the market does this and pulls back down before the 4-hour candle closes. If it closes down here below the swing high, then this would actually be a rejection of the breakout, because when we're looking at candles, we have the candle body and the candle wicks. The wicks show that the market has moved there, but has instantly rejected that level. So it shows a loss of momentum and strength of the initial trend. So the candle closure ended up being here. Now this means that the only confirmed price action within this price range is between this low, being the opening price, and this high, being the closing price. Anything above were just failed attempts of the price. This is also known as a rejection movement. And then this is confirmed price action right here. The confirmation is basically where the price has actually closed, while the rejection is the price where the market has tried to close but failed to do so. So why does this matter a lot? Because in this case, the confirmation has actually confirmed lower than the previous swing high. And the only push above the highs that we had was a wick, which instantly rejected down. Now this rejection actually denies the high likelihood of the market pushing above and continuing the uptrend. And instead, it signals that the market has a higher probability to retest the lows in order to gather more liquidity so it can finally break higher and maybe continue the uptrend. The problem with buying the wick is that you are basically buying an unconfirmed breakout, and this is how many traders get trapped. Because let's say they are buying anywhere near the highs because they saw that the market formed a higher high. Now they don't care that it didn't actually form a valid higher high with a candle closure, but it did with a wick instead. And their stop loss is usually below the swing lows, which is of course a psychological level. And guess what's the most probable price action now? The scenario where the market goes straight into the stop loss below the lows and moves back up into the uptrend next to the take profit, but with the position already closed at a loss. This is why waiting for candle closure as a confirmation plays a crucial importance. But now we also run into another similar problem. So if this wicks above and fails to close above, I said the most probable scenario is the market pushing into the lows. But what if the lows also wick down and reject right back to the upside? Well, in this case, when we have two rejected directions, the main direction we would look up to is the direction the main trend is following. So this being an uptrend with a higher high and higher low, I wouldn't consider this downside wick as a lower low, more like a liquidity sweep. For an actual valid lower low, we would want a candle closure below the lows. So knowing that we're in an uptrend, we have two options. We can right now look for buying setups, basically trying to front run and predict an upwards break, this being the more risky option, and we have the safer option, where we would wait for the actual upwards breakout in order to look for buying setups. But what if the market wicks the swing highs and rejects back down? The sellers gaining strength push the market into new lows, and the candle closes below the swing lows. Well then, in this scenario, the whole bullish price action invalidates, and the market is set for a reversal to the downside. Now this is when we flip our bias, and we now see this market as being bearish. So what we will look for now are selling setups. And if the market we are watching is not initially bullish, but is bearish instead, the same theory applies, but we are just favoring selling positions more than buying positions since we are looking to trade with the trend. But be careful because we want to clearly see confirmations with candle closures. So in this case, if the price closes with a candle below the swing lows, the market has confirmed the continuation towards new lows, so we can look for selling setup. But if the price wicks down below, but does not close below and instead it closes above the lows, well, then the market has rejected the continuation. And in this case, there's a high probability we see the highs being tested. And on the highs, if the price wicks again and rejected back down, their higher probability sits in moving the market towards the lows, because the highs have rejected. And the other option, if the wicks down the lows and rejects back up, while going towards the highs, and breaking the highs with a candle closure, this means that the market is reversing into an uptrend, and in this case, we might be looking for buying setups. So first, let's check a simple straight-up example, and later we will see that we can implement more concepts into this plan, and you can try any custom combination you like. So in here at the start, we got an uptrend. Basically, a heavy upwards push marking a higher high on the swing level, that is soon followed by a higher low that marks the downside pullback. So naturally, we are bullish right now. And currently buying positions are favored over selling positions, but no setup so far, so let's apply the strategy. We mark the swing high, and we mark the swing low, and we play the price and wait one level to either get broken above or below, or get rejected above or below. And the first important move looks to be a wick rejection on the upside. So the market has pushed up and tried to break above the swing highs to continue the uptrend, but has failed to do so because it has quickly rejected back down into the trading range, and the next candle breaks below the last ones. This shows that sellers are gaining strength. So the market has tried once again to break the highs, but this time has absolutely failed to do so. It didn't even get the highs, and this is a confirmed swing lower high. The internal structure also has lower lows, but what we care the most are the swing levels, and the swing low is this one. Now, if the market actually breaks and closes below the swing low, then this shows we're likely reversing into a downtrend. But if the market forms a swing higher low, or a rejection with a wick, that shows that the traders bought up the lows and are looking to take the market higher. So if case 1 of downside closure happens, we look for sells, and if the case 2 of rejection happens, we look for buys. So it looks that the market broke down below the lows and managed to close a full candle below. Now we can set up the sell position. For the setup, we can place it slightly above the swing low since we expect a pullback after a breakout, or it can also be right at the next candle that breaks the swing low. But in this example, I'll just keep it simple because the next ones will be way more complex. And that's basically it. On another example, this time we will apply more complex price action concepts. So starting on this market, the initial trend right at the beginning was bearish. Simply a push down with a pullback back up and a break of the lows. So essentially lower highs with lower lows. The break of internal lows are called breaks of structures. After each break of structure, we see a small pullback to the upside that is short-lived, which is then followed by another break of the lows. Now pay attention here on the last two candles. The bullish candle took the liquidity from the last candle and reversed back up instantly, pushing to the upside very aggressively on the next candles. This was the start of the reversal. This pump broke out of the last lower high. This marks a change of character, but internally, a bullish change of character on the internal levels happens when a lower high gets broken to the upside. But this also breaks above the swing highs, so also got a bullish change of character on the swing levels as well. So remember that the bullish change of character on the swing level happens when a swing lower high gets broken to the upside. This move forms a swing high, which is of course followed by a pullback, just like it is normal to be. A healthy move should more often than not be followed by a pullback to allow more orders to be opened so the market can then continue its trend. But here, what's very important is that this pullback itself is a trading setup. If you look closely, there is a fair value gap between these candles. So the market pulled back down into the fair value gap to rebalance the market, and then started a very bullish market structure. So basically just higher highs and higher lows. And now the breaks of structure have reversed. The pullbacks come after the breaks of the highs now. And that is because the trend has reversed from a downtrend into an uptrend. So now we got a bullish break of structure here soon after the change of character. Then we see a similar market structure of formed higher highs with formed higher lows. So basically just one more break of structure. And now let's get into the recent price action. Now we can apply what we learned in the first minutes of the video. So we mark the swing high, which is right here. And the swing low is the structural low that created this whole recent uptrend. And the responsible candle is this one. This was the candle that broke into a new structure. So if the market breaks down below this candle, we would likely see a trend reversal once again, but this time from a bullish market into a bearish market. But this responsible candle has even a more important detail to it. We need to question what has caused this upwards push in the first place. And that is of course because the market was bullish in the first place. But if we know that the market is bullish and follows an uptrend, and we look for continuation, then there must be something in entry structure this time that allows a better setup planning. And there is one entry structure that respects a continuation of the uptrend, and that is a demand zone. It's the demand that caused this continuation. So now applying the theory of swing levels, if the market slowly goes down, breaks down with a wick but instantly rejects back up. Usually it will form an internal change of character towards bullish side, but this change of character being present only on a smaller time frame. But the important factor is that if we get a wick and a rejection back up, we can look to buy on the demand zone to hold a continuation of the uptrend that we are already into. The other scenario is if the market breaks down below and closes below. In this case, we would look for a sell short on the retest to take the market into lower lows internally and on the swing levels as well. Now in this case, because of the demand, we don't actually care about the swing high. The priority is for trend continuation, and the only entry structure that allows this to happen is the demand zone. And if the market fills the demand, it automatically also either rejects or breaks the demand. So the price got into the demand, and the next candle broke below the swing low and rejected back up. So sellers couldn't close below. So the market might now look to pull back up to take more liquidity before doing any other swing breakout. And we can take advantage of this pullback with buying the demand. Stop loss below it. Take profit above the last internal highs, a perfect place to take out liquidity of the highs. And this closes by the next 5 candles with the take profit. Now let's actually look at what happens next if there is something interesting. So the market breaks down the last internal higher low. This is an internal bearish change of character. The other break was a change of character too, but to the bullish side. But then the market failed to hold this internal trend and has flipped again into a bearish trend on the internal price action. What we would expect now is a pullback back up to form a lower high, where we might look for a sell, and we take the market into new internal lows and as well as swing lows. So now we see price actually broke down below the swing low, and it also closed below with a bearish candle. This flips the swing market into a downtrend. In downtrends, if you apply price action, we look for supply zones, and the last valid supply is this one right here, basically being the last candle before the impulse to the downside. So placing a sell short, stop loss above the zone. Take profit at about 1 to 2 or 1 to 3. I wouldn't go more than that on a trend that just reversed. But we can manage the position after and make it a higher ratio. The problem is that it did not fill and just continue the downtrend. So we missed this trade. It's fine. The important factor is that you see that it works. So we got the closure below the swing low, and the trend has flipped from an uptrend into a downtrend. Now we see formations of lower highs and lower lows, and eventually an opportunity will appear. Now we can refine the setup even more. Let's check that into another example. Starting with the market structure analysis on this price action. At the beginning, we had a large downside movement representing a downtrend structure. Downside movement that is short-lived, because shortly after, the market starts a slow climb to the upside. This slow and continuous uptrend on the internal structure moves into breaking the last internal lower high, which sets a bullish internal change of character that basically flips the internal trend from bearish to bullish. But we also have the external bullish change of character. this being formed by the market breaking above the last swing lower high. So for now, the market is reversing into a bullish price action, having a higher high, a pullback with a higher low, and another attempt to break the highs. However, it failed to do so currently. So we mark the structural swing high and the structural swing low. This is where a lot of people get it wrong. So let me explain. What we care about on swing levels are the structural levels. So for example, if here we have an uptrend with higher high and higher lows, this is the structural swing high, and this is the structural swing low. Because if the market were to break this high, we would probably look for a continuation of the uptrend. And if the market breaks and closes down below the structural swing low, then we have a change of character that flips the market towards the bearish side. In this case, we would look for sell positions. So now let's come back into the charts. So having the swing levels, we just wait one to either reject or to break. Now the internal price action can also be used for analysis. In here, we see a lower low internally. This shows that on short the time frame or on the internal structure, the market is more likely to hold this downtrend for a while. But the market itself is still bullish overall, because we are still above the swing lows. Well, now it's when we are bearish on this market. See, the market broke and also closed with a full candle below the swing lows. Now the refinement option is usually done for scalping positions. So what we do after the valid breakout is to zoom into a lower time frame. By the way, this current time frame was the 1 hour time frame. Now we zoom into the 5-minute time frame. Now in here, what we can do is to look for an entry structure that favors our trend view, being a bearish view of the market. So we would look for supply zones or for bearish fair value gaps. The closer they are to the most recent price, the better. Now there was one invalid fair value gap here, but this is not even a fair value gap because it does not leave an imbalance between the candles. Notice how this wick takes out more than half of the next candle, and the higher wick of the candle to the right also fills out the candle. So this is an invalid fair value gap. Now there is a valid fair value gap right here that just got filled a couple minutes ago. We missed this. But we can use it once again as long as there is not another entry structure than this one, especially because we expect a pullback to the upside after a valid breakout. Now we can look for a higher risk to reward ratio setup and a more riskier, but also a safer setup with a stop loss closer to the extreme swing highs. And the take profit is clear. On downtrend, we're looking for lower lows, so of course I'm placing the take profit below the lows. So we got the pullback that triggered the setup and an instant rejection to the downside. Now we form internal lower lows and internal lower highs. Very simple setup. And the market actually went much lower. So basically, after breaking the swing lows, it flipped into a high time frame downtrend. On downtrend, the market looks to be taking the liquidity of lows by breaking them down and forming lower lows. And it's what it has done, because it has taken this swing low, this as well, this one too. But it bounced up on the last one. Now we would look for buys only if the market first takes out the liquidity from the lows and starts climbing up by forming higher highs. So basically a change of character towards the bullish side. Then we would want a pullback that forms a higher low, where we would look for a demand or a fair value gap in order to take the market into new highs. But unless this happens, the market is still bearish and sell positions are favored over buys. So let's summarize what we've talked about in this video. As simple and quick as possible. We first look out for the main trend. In this case, if we zoom out, we see a main downtrend being in play, with protected highs that don't break, so essentially swing lower highs. And we also got the lower low formations, which are expected on a downtrend. They are basically the breaks of structure, so we know that this market is bearish. Then we move into the recent price action. On the most recent price structure, the price pushes up from a swing low into a swing high. So simply, we just identified both structural levels. We got the swing low, and we got the swing high, and now we just wait for one to break. The more probable scenario is that the lows will break because the main trend is a downtrend. So lower lows are expected. Know that this market is bearish. And we got the break and closure below the lows. Now here it almost did before that, but has quickly reversed back up and close above the low levels. But shortly after, on the next candles, The market this time closed below the lows. Now we have two options. We can trade on this chart for a swing trade, or we can refine the setup by zooming into low time frames in case we want to scalp the market. Now in this case, we keep it simple and we stay on this 1 hour time frame, so this is a swing trade. On swing trades, we expect a larger pullback. So in case of a swing trade, we look for an entry structure at the extreme levels. In this case, we look for a sell position, and we would like to sell at the highest price we can get. So that means that it might be more profitable to look for an upper supply or a fair value gap. And there is one large bearish fair value gap right here. So we simply sell with the entry on the gap. This being a swing trade, I will place the stop loss above the highs and take profit around 1 to 3 risk to reward ratio. Or if you're a more risk-seeking trader, you could also look to take the market into lower lows with a much higher risk to reward ratio. But 1 to 3 is enough for me. And now we just wait for the market to pull back up into the gap. So here the position got triggered, and the internal price action quickly flips into a downtrend, which then moves into take profit. If you're looking for everything you need to get funded using these strategies, we simplify trading as most as possible. You have my resources on the link in the description, and thank you for watching my channel. Have a great trading session, and see you on the next one.